Is residential property investment dead? And if it's not, what is the best strategy for 2026? Pursue a capital gains tilted property, something that's likely to rise in value significantly as interest rates inevitably have to head lower? Or should you still target properties that pay for themselves, cash flow positive properties? In this one today, I'm catching up with an expert, Nick Gentle from iFind Property. We're going to have a conversation to talk about just that. If you're new here, my name is Darcy Angaro. I'm a qualified financial advisor, and I work with everyday investors of all sorts, helping them to build their own portfolios, which may include property, shares, managed funds, and even crypto. Hope you enjoy this one. If you do, leave a like, leave a subscribe on the way through. Let's get started. Let's start here. Back in 2023, on my blog, I wrote that once mortgage rates fall roughly below 4.5%, a lot of Kiwis will start thinking about the maths, and they will flip the switch from renting to buying potentially. And now that we're seeing sub 4.5% interest rates in late 2025, that's time of recording, are you noticing that there's a shift in buyer sentiment, or is the state of our economy or the news cycle slowing things down?
All investment markets tend to people like surge in, and then you move as a school of fish, and you definitely haven't seen a large chunk of people making the decision that now is the moment to go and buy the house that they've been waiting for. I think as interest rates have come down, buyers have made the decision that now is a good time to get in. I think a lot of them are making that decision based on price. Prices have fallen, and you can buy a property and lock in the mortgage rates for 6 months, and then later this year or early next year you can get the same debt for cheaper in theory. So there's been a steady progression of people doing this. However, as I'm sure you're aware, there's a lot of bad news around job security. The economy has not been good. The Reserve Bank engineered in a recession, and so I think the last constraint sort of domino to fall is going to be around job security and some confidence. So some healthy GDP data, hiring intentions, things like that, we'll probably see more people moving over. I also have no idea how many renters sort of unfortunately left New Zealand looking for other opportunities. So I mean, that data is like multi-layered and nuanced. So yeah, while I do see people making that change, there's no noticeable mood change. One thing that has happened in the last couple of weeks is when the Reserve Bank announced the latest cut, there was also commentary that this is it, we're done. And so that saw some immediate repricing in the swap rates, the market for interest rates, basically betting that the only way is up. And I think Westpac were the first to put their rates up. And so every mortgage advisor and bank has run off their feet right now, as a lot of people have suddenly concluded, oh crap, I need to refix, because here's a bottom, and I'm going for it. So whether that leads to also people who have been sitting on the fence to, oh, I better go buy the house because it's going to cost more in the future. I think data will come through next year showing if we've seen some of that.
In light of what you're just saying right there, do you feel like there's a certain amount of jawboning, or what do we used to call this, oral persuasion going on, where the Reserve Bank of New Zealand is talking the market down rather than actually changing the interest rates? In other words, they're threatening that the interest rates are at a new level, but you kind of get a sense that there might be more in the tank.
I'm not buying that we're done, but I certainly believe that they've talked the interest rate market up a bit. Nothing changed in the economy in the last few weeks. The data is still not particularly great, and we're seeing this spike, and that's based off commentary. And I think there's been some pushback from a couple of bank economists I saw. I think it was the Kiwi Bank lady basically said, the way the bank needed to leave a little bit more scope for adjusting to how the market, the actual data, rather than making a declaration of intent that's far out. But heading into COVID, our interest rates in the banks were under 4. The global economy was sort of more and more tightly around low rates. When you get an economy around low rates, you lose. It becomes quite sensitive to increases. I've seen Japan and other economies, any up just creates a real pullback. And I
Yeah.
just had this feeling that was sort of, it's been this general trend downwards
Mm.
for many reasons. I mean, you can go off and study this stuff and interest rates over a cycle. And I just felt that for growth to pick up again, we kind of needed to get closer to where we were before we got into that whiplash COVID era, which was just weird.
Yeah.
So I felt like we were probably another 1/4%, if not more, away from being sort of back to where things were before.
Yeah.
However, we're probably within the what do you call it, the close enough range of error where I could be wrong. I'm frequently wrong, but I do
Yeah.
believe I'm not buying the Reserve Bank's statement that they won't come down anymore. I just think
Yeah.
now that they've made these comments, uh, they're probably going to have to then back that up with a bit of a wait and see approach, which is a little bit disappointing because that will push out perhaps the recovery more than it needs to be.
I totally agree. Like over the last few years, I've been fairly critical of the Reserve Bank, which is easy to do when you've got nothing to lose, or you're not looking for a job there, or you don't know as much. Like I'm probably like you, I'll be the first to admit I'm not an expert in a lot of these things, but it just doesn't seem right. And the way that they have engineered bubbles as well as the troughs just doesn't sit right. Just fiddling with the credit conditions to manipulate, to control the market for whatever aims. It's almost like they'd be better off just leaving it alone. And when we look at today's settings, we have easing interest rates marginally, and it's debatable as to whether it will keep on going down. I personally think it's going to go far further. We have looser speed limits in terms of high lending ratio limits. And I'm wondering if we're going to see the cycle repeat. Like, in your opinion, do you think that we will see the Reserve Bank of New Zealand forming another property bubble because they'll be forced to drop interest rates lower?
I'm not 100% sure how the introduction of DTIs are going to
Yeah.
restrict future bubbles. I hope they do, because but I don't like investors like boring, right? I
Yeah.
just want to buy the asset based on my research, put it over here, and then focus on buying another asset or making another investment. I don't want to be managing my way through booms and busts and sideways and this and that. Because every time there's a bubble, there's a political reaction. I mean, we saw that with the Labor government. So I don't want to see another one. However, and so the DTIs were brought in to address that. So potentially that means that price increases will be tied to wage increases, which is tied to general inflation as opposed to property increasing faster than inflation, which would probably be nice and healthy.
Yeah.
One of my favorite things to remember as an investor is I buy a property, I borrow the money. My mortgage doesn't go up with inflation, my value does. So it is positive. Some inflation is good for house owners because your debt gets eroded uh, relative to your the price. However, too much and you just get the up and the down and the sideways. And then there's other issues like we've seen population problems. People left New Zealand, so people who thought they could set up a life in New Zealand have concluded that that is no longer the best option, and they voted with their feet.
Mm.
It's very similar to what happened in 2009 and 10, and
Right.
it's incredibly sad when that happens. And so stability I think, is better. So I
Yeah.
hope that we don't see another boom.
Yeah.
Uh, However, in in previous cycles, these constraints that get added, like LVRs and different things, um, they tend to get eased back when markets don't improve, and then markets tend to start to take off, and they take a bit too long to bring those constraints back in, and that's when things can run away on you.
Yeah.
So it'll be interesting to see if what they take away, if, as I feel, we don't see an economic turnaround in the next 12 months.
I guess what you're saying is that the more we put controls on what should be a free market, the more we exacerbate the natural cycles that would otherwise exist. And because of that delay, right? Like with the
Mm,
DTIs, they'll probably be late in adjusting those things, which will then lead to a continuation of whatever trend was already there. And time will tell, right?
yeah, I haven't dug into it too much. The DTIs, I believe, are brought in higher than other countries have them set at, and that was just to
Sure,
allow people to still buy and sell properties at the prices that we're at. Now, if
sure.
interest rates go down and affordability goes up and serviceability and also wages increase, then all of a sudden
Yeah,
we could see some big jumps in prices still within the DTI scope. But I remember the first time in 2014 or 15 when the market started to spike in Auckland and they introduced 40% LVRs.
yeah,
Um, and as the market pulled back, that went to 35 to 30 to 25. And I think during COVID, they dropped it completely. I can't quite remember.
yeah,
And so the bank tends to add and take away these things in response
yeah,
to how risk, but they
yeah.
can be a bit late to the game.
Oh,
And
yeah, totally.
there are bubbles in some towns and nothing in another. So
Yeah.
it can be very hard to. I'm not envious of their job.
Yeah, I kind of wish they wouldn't do their job sometimes. Yeah, because I remember when the loan to valuation ratio restrictions were loosened during the post March 2020 period, where yeah, they allowed you to borrow up to 80% for rental properties again. That really just supercharged an already really amped up property market with ultra low interest rates. And DTIs, just for those that are unfamiliar with that term or that three-letter acronym, it stands for debt to income ratios, and it's just another control that the Reserve Bank is macroprudential control that the Reserve Bank of New Zealand overlays onto the banks to ensure that you cannot borrow a certain multiple of your income. And I think that multiple will probably change as well over time. I can totally see that happening. We have seen a huge jump in new listings. Well, you can tell me if it was huge or not, but from October, November of this year, one of the biggest jumps in new listings, with some regions that have gone back to 2018 levels of fresh housing stock coming into the market for sale. So, do you think that this is distressed vendors looking for an exit, or is this just normal activity for this time of year?
I think it'll be a range of things. Um, I've owned a lemon, which is code for a bad deal. I owned it for 7 years, and the property recovered to the point where I could sell it and get my money out, which I think after inflation meant I got half my money out.
Right.
And I just was tired of owning it. So there'll be some people who have owned it through a downturn and don't want to do that anymore.
Yeah.
Perhaps they paid over the odds for it in 2021, and then it was just they now finally realize interest rates have come to where they are. Here, I got to sell this thing.
Yeah.
Spring is when most listing numbers increase. I'm sure. I think the interest.co website gleefully publishes stats around versus every year. Here's the highs and the lows and this and that. I think it's just, again, a lot of people left New Zealand and they would have become accidental landlords. Um, Perhaps some of those were trying to rent their properties out while they're away. Perhaps that was difficult and they want to sell.
Mm.
Uh, sort of all of the above, really.
Yeah.
I don't think there's a silver bullet.
Yeah.
Uh, could be the economic climate, although since your biggest cost in a property is interest costs, sorry,
Yeah.
uh, unless you've lost your job suddenly and your circumstances have changed.
It feels like there's a bit of a buildup in terms of people that have been hanging on for a while, desperate
Mm,
to get out because of what you just said before. Hey, interest rates went up. This isn't as cool as I thought it was going to be. It's not simple to make comparisons generally in one country versus another, but that kind of leads me on to the next question, which is kind of like looking at the superstar city in each country, three countries specifically: New Zealand, Australia, and Canada. So I'm thinking about Auckland, Sydney, and Vancouver, those cities and those countries. And since 2020, in those three markets, we've all ended up higher. Obviously, everybody has in terms of the nominal prices for property, but the paths have been a little bit different. Sydney and Vancouver appear to have run much harder, faster, higher overall, while Auckland seemed to have had a sharper boom but a deeper correction. So what do you think is the cause here between Auckland breaking away from the other two cities in terms of behavior, where the price had a serious correction and now we're only just coming up for air?
I think we're back to our Reserve Bank um, and how they've conducted themselves. Probably also combined with the political parties and their policies. Because the bank, while it's independent, you can make a lot of noise if you're the Minister of Finance. And so probably what we always forget is New Zealand went into lockdown, then slashed all of these holding costs to allow people to basically stay in lockdown and not work and hold on to their assets.
Yeah.
And then implemented a very, very successful zero COVID policy, which meant that the economy was trading relatively normally for a large chunk of it, if you exclude the second lockdown and then Auckland having their own lockdown. And so these interest rates just got left really low for way too long. The Reserve Bank went out and got extra funding to support low interest rate lending for a long, long time. And while the initial crash down probably made sense, it didn't need to be there for more than a few months. They could have raised the OCR saying, hey, look, it looks like the policy, where it was starting to overheat, the country is trading to an extent, we're going to go to a different level. And then the pullback the other way. So as soon as inflation came in, New Zealand targets inflation harder than Australia does, I believe. And so our rates went up to 7% because inflation reared its head. Inflation reared its head everywhere. And so it's really interesting to go and look at how all the central banks around the world reacted to inflation. And again, me with my unqualified opinion, I thought that we had a supply shock and it was going to flow through and things were naturally going to come back down, and it did. And so the countries that didn't aggressively hike rates fared better because the inflation happened anyway, and then it dissipated largely anyway. So by leaving rates too long, not recognizing that the economic situation, that the rapid lowering of OCR down to virtually zero, I think it was there to support that situation changed quite quickly, and then not recognizing that and holding that in place for ages, and then hiking up super high and only waiting for, our CPI data is like 3 months late, right? So we had to wait much longer than we should have really to start to lower rates, and the decrease has been really gradual, which is the other thing that bugs me tremendously. I think the interest rates could have come down by the start of this year to where they are now, and it would not have triggered any spike in inflation or anything now. And you just give a bit more breathing room earlier to businesses. Only now are we starting to hear about business confidence improving. It was really, really strange, the fact that we just had to come down like inch by inch by inch by inch by inch, when in every drop was like, okay, is there any economic activity? Okay, no, we'll come down a little bit more. We'll come down a little bit more. When it was obvious to anyone who was at the coalface that just the business activity and confidence was in the doldrums.
Totally.
And if rates had come down really quick, we weren't going to run off and see another boom, not with rates coming down to 4.5%. If rates had gone back down to 2.5%, then yeah, sure, of course it would have gone crazy again. But no one was ever talking about that. So I think the long retreat really did hurt Kiwi businesses, and I think a lot more people now live overseas than would have if we'd gotten back to a sensible level sooner. Because I think folks just gave up waiting for jobs and opportunities to come around again.
Again, it's like the Reserve Bank of New Zealand has too much control and it changes behavior in obvious ways. Like people give up, they're tired of waiting. It's like that blood pressure thing that you get put on, right? It doesn't take much for it to really start to feel like it's constricting your blood flow and it feels really uncomfortable. You kind of wish it would stop right away, but just slowly letting that pressure out, it just feels like you're about to pass out the entire time. Maybe that's just me. And I think that it's really interesting how in New Zealand we adopted a really draconian, in my view, a very draconian response to the pandemic with very heavy-handed lockdown procedures without a clear evidence of the gain, or at least not very significant analysis on the financial implications. And then over the
Mm.
top of that, you had a very overzealous Reserve Bank dialing things up way too high after leaving it way too low, all the while being way too slow. And now I kind of feel like we're probably just going to see more of the same, but even more extreme going forward, unless there's a fundamental shift at the Reserve Bank of New Zealand in terms of its culture. That's my subtly biased opinion, but let's let's talk about politics now as well, just to really ramp it up, right?
Uh-oh.
How much do you think that like obviously Canada and in Australia, probably more on the left of the spectrum, we could say, and if you're on the right, probably more extreme left is what you could say. And again, if you're on the left, you're probably thinking that in New Zealand it's far right, but let's just say for argument's sake, it's somewhere between center and right. So New Zealand being the odd one out in terms of its political leadership at the moment, do you think that that plays a factor in terms of the house prices? Like, do people discern the difference, and do they understand that usually under a Labor government in New Zealand, house prices go up, and in national they go down? And do you think that people are kind of responding accordingly?
I think house prices go up because credit conditions get looser, as well as other factors. And Labor tend to, or left-leaning governments tend to be, I'm going to say this wrong, is it profligate in their spending, willingness to borrow and spend. I mean, how much debt did Grant Robertson and Jacinda Ardern take on to in their window? It's
Yeah.
crazy. And as a result of that, business confidence, lending, money starts to flow around. I'm a big believer that there's under every property cycle, there's a credit cycle, and credit expands and contracts. And when we get to boom levels, suddenly banks start to get nervous, and then we have a contraction, and that flows through to assets. And so when you have a Labor government that is, hiring and borrowing to do stuff, that creates extra. The debt comes from somewhere, but then it's spent in the economy, and that just creates extra money flowing through the system. And that is why I think house prices go up under a left-leaning government, not because they want them to. They actually
Yeah.
campaign on the opposite. But I would be very surprised if Labor won the next election and didn't suddenly go on a borrowing spree, and that led to everything suddenly feeling better.
Yeah.
But we're still borrowing from our kids' kids to do
Yeah.
stuff today. So that's it's a generic thing. But mind you, at the same time, you look at the Americans; they've got a right. I think you can call them a right winger in charge, and where's their debt gone? So the ideology around the Republican Party of the US was smaller government, less spending, all of this, but the amount of money being borrowed to just keep
Mm.
some kind of party going
Mm.
is crazy. So it's not necessarily left right, I guess, but historically it was, and our current government has definitely had to take an austerity approach to some degree. They just could not keep everything going.
Yeah.
I'm disappointed in our current government, who I voted for, that there hasn't been some more fiscal policy, which is different from monetary policy. Fiscal policy comes from the government, sort of stimulus, some larger infrastructure,
Mm.
core stuff to keep things happening, like make some long-term investments. Actually, the last government borrowed a lot of money to pay for emergency housing, and could only, it disappeared, even though it solved a problem. The money, there was no long-term uh, um,
Payback.
positive momentum for New Zealand payback for the
Mm.
people who were funding us, ultimately me and other taxpayers. How about we go and kick off some roads or if you're going to cancel the ferries, come up with another ferry approach and actually do that harbour bridge or do that railway tunnel or build those schools or things like that. So at least all the construction expertise that's left in New Zealand, at least so you can't just sit there and stop spending and wait for the Reserve Bank to lower it to where it starts again. You kind of need to come up with some initiatives on your own.
Yeah.
Which seems to be coming through now with some recent announcements around policy changes and investment. But I feel like it's far too late, and you kind of still need to go out there and say, well, look, we believe in New Zealand, and here's a few things we're going to build or do, or
Yeah.
actually leave a positive legacy.
Yeah. So let's talk a little bit about the future. CBRE figure that New Zealand house prices have grown roughly around 7% a year for the past 30 years, which I think is probably true almost up to 50 years ago. But long run rent growth sits near to 4%. So we have a 7% growth rate and a 4% growth rate. And my own theory is that as interest rates decline over time with lower lows, lower highs, the trend is always down. My thinking here is that house prices will rise faster than rents will rise even more in the future. And so when I think about this in terms of an investment strategy, what's a rational response to that if that's true? Well, surely it should be to pursue properties and acquire properties that are more prone to achieving capital gains rather than fixating on a strategy that produces yield, like relatively good income over the purchase price. What are your thoughts around a capital gains strategy versus a yield strategy with residential property generally? And do you think that that's going to change in the future?
Good question. All right, there's a bit to unpack there.
There is.
So, I yeah, you're right. So as interest rates come down, property values always move faster than rent. They move quicker. There's a few reasons for that. One is, a lot of Kiwis don't put their rents up every year. When you have a tenant in your property, when you sell a property, you try and get the absolute top dollar you can get. When you're renting a property, you've got a tenant in place. While it's nice in theory to get the absolute top dollar you can get all the time, often people will just leave the rent where it is or do a smaller increase because the tenant's easy to work with. They're looking after the place pretty good. You've got letting fees and other vacancy costs when you change tenants. And some people, they bought the house at a price, they're happy with the rent at a price, and they forget about it. I see that a lot with self-managers. Property managed rentals tend to have a bit more of a process about market reviews, but it typically lags. And it is also, it's very difficult if you're in a boom and let's say there's a 20% increase in house prices over a year, which we saw in 2021, to turn around to your tenant and say, all right, you're going up, your rent's going up 20%. And that's a much more
Difficult,
difficult
yeah. Yeah.
and societally destabilizing thing. So what tends to happen is that rental increases tend to be steady and smaller. And when property prices are flat, you might still see steady rent increases. So they sort of go up in different ways. And then if the population declines, as we've seen in a couple of centres, rents can even drop. So there's a bit of a supply and demand dynamic around that. The strategy approach. So I have always advocated for cash flow within reason, and that's one of the reasons for that is most investors will buy a rental with equity in their own home, and if you are making a loss on that, you have to pay that loss every year. And if you bought a townhouse off the plans at peak construction prices in 2022, you will know this because you will have made a loss every year. And then if you go back to the bank and you want to get another property, they will look at your salary and they'll look at your mortgages and they'll see that you're making a loss and you're topping up rental A, and they might not want to lend you for rental B. And you also might want to sit there and go, oh, well, I've got a job and I've got kids and 20% of my discretionary income is going to topping up this mortgage. If I do it again, I'm at 40% of my discretionary income. So the serviceability thing is a big constraint to building a portfolio. And success, to me, successful property investment is about the portfolio. It's not about a single property. And by that I mean when the gains come and when the markets turn in your favor. If you've got 4 or 5 properties in place versus one, your windfall is going to be an order of magnitude larger. In order to get to that point, your rental portfolio kind of needs to be paying for itself, if not better than that. Otherwise, the banks are going to get to a point where they're going to say, no, you can't afford this. Even if you want it, even if it's going to shoot up in value, and you know it's the deal of a century, if you can't cover their holding cost calculations, they won't let you buy the property. So you sort of need to be a bit nuanced in that. There is another way through that. Obviously, that's to buy a project, fix it up, sell it, and take the capital, and then use that to buy your other asset. But if you're just repeatedly, slowly building up a buy and hold portfolio, you do need a healthy dose of cash flow if you want to get past a certain number of properties. I think you can have your cake and eat it too. Look, if you've got one house and you've paid it off, and your one other house, and it's across the road, and it might have been your former home, and you've got very little mortgage, then your dynamics are different. But most investors are borrowing the money to do it. Just the probably some folks will know this, but banks use different rates than what they advertise to assess your ability to pay debt. They call their testing rate, and it's normally a couple of percent higher than what's being carded. So at the moment, if you went into the bank and you wanted to borrow $1 million to buy a 2-flat property, they'll assess your mortgage as if it was 6.5% or 7%. And even though you can borrow the money at 4.5%, during the COVID boom, they were assessing at 5.5%, even though you could borrow the money at 2%, which is one of the reasons, in fact, the biggest one, why we had very, very few mortgagee sales this time around, even though interest rates went to 6 or 7, because the banks had tested at 6 or 7. In 2008, we had hundreds and hundreds and hundreds of mortgagee sales and foreclosures in New Zealand because the banks did virtually no serviceability testing in the run-up to 2008. And it was all about equity games. So people were building portfolios based on what we call helium. Yeah, this is what we do when people come to us and they want to invest. We talk about the portfolio they're going to need to achieve the financial outcome that they want. And then we can layer on top of that, okay, well, in order to get the third property, you're going to need the first 2 to stack up in this way. And here's your type of cash flow you're going to need to go and get your next deal. And you can create cash flow, you can remodel, you can renovate, you can subdivide, do a partial sell, you can pay a high deposit. I often encourage investors to talk to their broker and find out what the first deal or second deal needs to look like in order to keep going. Now you can still do the capital gains approach. Now I'm a bit cynical. I don't think there is a capital gains versus cash flow approach per se, but you can still go and buy your lower yielding property in a better area and wait for the windfall. But you're better off doing that towards the end of your acquisition strategy when you've got the other properties kind of supporting it, and that way it's not taking money out of your pocket while you wait for that to come around.
Sure.
If you went and bought your first rental in 2021 and you ignored all fundamentals and bought it at 3% yield, the next 3 years would have sucked. Whereas if it had been your third rental and you had a couple of others that you'd bought and slowly got to a point where they were providing positive income, it still wouldn't have been fun, but you would have slept a lot better because the bulk of the holding costs would have been covered by the other assets. So the portfolio sort of supports itself. One of the things that's worked for me, and ironically it's in Wellington, which has probably been a really fun place to own property for the last 3 years, is I would buy in very, very good areas and remodel, add bedrooms and things like that, so to create a yield higher than you would get if you just went to Trade Me and bought the house. And so I'm trying to have my cake and eat it too. The problem with that strategy is to get into those areas is expensive. So I got in there after I've been doing this for 5 years, but the outcome is positive. You can, if properties in your thing are at 4% and you've created 7, then you've also created lots of equity. You are going to get capital growth when it hits that suburb. In the meantime, your bank balance looks pretty good from a cash flow perspective, either not going down or paying the debt off for you or whatever it is. So there are approaches with a bit of nuance that kind of get you around that. But hey, I've been doing this for so long that I live in Rotorua, and I remember buying my first rental in Rotorua for $150,000 in 2011, and that same house today is worth $500,000, and that was a cash flow positive, cheap property on a in a rental district. So
Right.
you can't tell me that that I need to choose.
Yeah. Sometimes you don't need to choose. I guess there's factors though, right? Like whether you're in the building up phase or you're in the winding down phase, what do you need your portfolio to do, right? So go ahead.
Very good. Can I add to that? Yeah, you made a very good point. So if you have built, once you've built up, one of the other things I've helped people do is basically take their capital that they've built this asset base of and turn it into something that they want to own for the next 40 years. So you can, if you know, with cash flow positive, smaller, cheaper deals get to a certain point, and now you want to get into a bigger, more interesting type of asset, better area, more value, perhaps, you've reduced your debt, you can,
Mm.
that is, I think, a good time to move across. Um,
Yeah. Yeah.
yeah.
And just for background, the reason why I actually initially reached out to you is I was dealing with a client who we had established that the next best course of action for them was to invest in property, and it wasn't good enough. It wasn't good for them to be in the area that they lived in. I wanted them to look outside of their area with their next property purchase, and for them, they were like, "Well, we don't know anything about those other areas, and we don't really want to be sold to by talking to some other businesses. We actually just want someone working for us to help us locate this property that you recommended with these following characteristics." And I did a bit of research, found you guys, and then realized, well, I probably better do some due diligence on you. So I reached out to you, had a call, talking to you now, of course. But why don't you talk to us about what your model is? How do you work with everyday investors, specifically property investors who are trying to grow their portfolio?
These days we're called a buyer's agent. I think 10 years ago we would have become property finders. So depending on how long you've been doing this, it'll be one or the other.
Mm.
So we take investors through a process where and most of our clients are like you're a client. They're in one city looking to invest in another area, or they're new at this or unsure. They're busy, got jobs, kids. The weekends are already full. A lot of Kiwis overseas looking to somewhere to put their money to good use, so they've got something to come back to. We walk clients through a process where we help them. We're not financial advisors, so we will recommend they go and talk to a mortgage advisor, a financial planner, an accountant, get some structure and advice. Just make sure that property is the right thing for them, and then we'll help them plan a portfolio that over time will get them to wherever they want to get to. So that can be different areas, different price points, different configurations. People like different ages of properties. People like new, like existing. They like do-ups, done-ups, standard homes, blocks of units, smaller towns with higher yields, bigger cities with more certainty of areas. Every client is completely different.
And
Um,
you're not just pushing one type of property type either, are you? You're looking
no,
across the spectrum, right?
no. What our bread and butter is probably existing homes. That's what people tend to come to, and what we're known for is cash flow and equity through existing properties. However, we do new, but it's a bit more targeted around investment. So we don't promote, nice 3-bedroom townhouses at retail and say that just buy this and over time it'll go up in value. That works for a lot of folks. It's sort of a superannuation approach to a property. We're a bit more, you will be paired up with a qualified investor in this town, and they will take your goal that we've helped you work out, and they will go out and look at properties or put options in front of you that will help you achieve your goal. And they will have done some analysis, because this is what they do. They'll introduce you to their local property managers, local builders, local networks. So you don't need to know anybody. You don't need to know the market. They'll help you get a property at a good price under offer. They'll help you with the due diligence as much as you need or want. And so the elevator pitch is that you buy through the eyes and ears of a good investor in the way that they'd buy themselves, but you're not actually doing any of that. And you're at
And
home, and it's
when
being
you
done for
say
you.
when you say an investor, you're talking about someone who works with iFind Property who
Yep.
is an investor themselves, right?
Yes, so everybody in our team is a property investor like me, full
Okay.
time at this, and they once I've or my business partner have qualified a client and helped them work out where to start and where's a good place to go. They get introduced to our person on the ground in that particular market, who only really looks in that market. We only put properties in front of clients that we've seen ourselves in the areas that we know. So it's sort of a concierge consulting service.
Yeah.
And
What
again,
what does the revenue model look like from your perspective? How do you guys make money?
we get paid a fee by the buyer on a success fee. So we charge an agency fee for success. So once we've got you an unconditional property, we run some numbers for you as we look at a deal. So purchase price. Here's our fee for the service. Here's what you might spend on doing up the property to make it hit the numbers that we need to do, and here's your total price, and here's your total yield.
Yeah,
And so within that total yield hitting their goals, we have our fee.
got it. And do you mind me asking, what is that fee?
Yeah, so it's typically around 2.95% of the
Yeah,
price,
yeah,
but it does taper off if we get high, because you
yeah,
start to, we've got clients with $1.52 million budgets, and
yeah.
it can get a bit chunky. So we keep it pretty reasonable.
But I guess the other part of this is that you'll be dealing with real estate agents as well. So is there ability to share commission from the selling agent in some instances, or does that create a bit of a rebate situation in some instances?
Yeah, that's against the law,
Okay.
to be
Well,
paid
I'm
by the buyer and
glad
the
I
seller
figured that
agent.
out.
Yeah, I don't know if that stops people from doing it. I'm sure
Right,
there's businesses out there that do backhanders
right.
all over the place. But so we're a licensed real estate agency, so we've got some pretty strict guidelines. We're under the
Yeah,
same umbrella as a Harcourts or a Ray White. So
right.
every real estate transaction, a salesperson has a client, either the seller or the buyer, to which they have fiduciary responsibility. They're only paid by that, and our agreement with the client basically explicitly says, look, we wouldn't get no other rebates or discounts or commission shares or anything from anybody else. But ultimately, we're trying to get the best possible deal, because we want that client
Yeah,
to have a great experience, tell their friends, and come back in a year for the next rental.
yeah, perfect. No, that's awesome. And right before we go, you also have an online course of some description. Can you just explain how that works? Obviously, it's for property investors, so how can people access that?
Yeah, just jump onto the ifindproperty.co.nz website. It's in the menu. It's currently, it is a bit dated, but the content is solid. I wrote it myself, and I do a bit of coaching, so I think it's good.
Yeah,
It is email based. There's about 10 lessons.
good.
And I like to say I'm in the process of re-recording it as a series of video lessons and things like that. I've been in process of doing that for way too long, so it might be my summer job.
Yeah,
So if you sign up for it, you will get notified when it comes, when
yeah,
version 2 comes out, hopefully early next year. So it's, how to set goals, how cash flow works, how equity works, how to borrow against an existing property, how to find deals, different ways to negotiate, different ways to do due diligence, how to manage other team members, like a mortgage advisor, an accountant, what they do, structuring. So it sort of goes
sure.
through the fundamentals without being a 300-page book.
Fantastic. Thanks again, Nick. Really appreciate it.
Appreciate your time. Thank you so much for having me today.
Thank you.